What's up, guys? John here. The CEO of the world's largest bank just issued a dire warning to 330 million Americans about 2 hours ago.
Head of the country's biggest bank sounding the alarm that inflation could soar past 8%.
Expressed concern about the resilience of the U.S. economy because he believes it's being fueled by government spending.
Stating where we're likely going to be going in this economy and what we should all do to position and prepare ourselves for this. He is warning that we are going to see inflation go back to the 1970's period, where it skyrockets over the next decade.
I'm a little more worried that it may not be so soft and inflation may not quite go away. It looks a little bit more like the 70s to me.
In fact, coupled with this, he's warning about stagflation, where inflation skyrockets, but job opportunities pull back and the economy slowly grinds to a halt. This is a great position to be in if you are a business owner, if you are an investor that has cash, because what's ultimately going to happen is inside of these cycles, people that are leveraged are going to be forced to sell off second homes, work trucks, land. They're going to be forced to sell off things to feed themselves because the price of everything is going insane. Like, for example, I saw this on Twitter saying a Chipotle double steak bowl is now $39 in California. They fact check it. They say, no, John, look, this is only $21. It's not $39. Then I scroll down here, and this guy's putting a picture of his invoice from Five Guys. He's like, look, I got 4 cheeseburgers. It's $56. I got 4 regular fries. It was $115, right? Now, they say $5 tip here, $19 service fee. So let's remove this. Remove the $20 from it. It's still $85, or $95 rather, for 4 fast food burgers and fries. That's where we're at right now.
Expect to pay more at your favorite fast food joint this year.
Prices at fast food restaurants are on the rise.
Wendy's raised its menu prices by around 8%, while Chipotle Mexican Grill hiked its prices by approximately 7.5%.
You have Wendy's doing surge pricing. You have prices going up across the board. Even Starbucks just increased their prices 7%. Now in this video, I'm going to show you what Jamie Dimon is saying is actually going to happen next and show you how far we've come as a society since 2018, just to kind of bring this all in, because I think a lot of people forget. You know, in 2018, the average price for a 1-bedroom apartment in America was $1,025. You know what a 1-bedroom apartment is now, median? $1,987. $2,000. So the price of an apartment has increased by 100% over the last 6 years. That's where we're at. And Jamie Dimon's warning things are going to get a lot worse. Now I want to break it down for you. Please hit the like button. Hit the like button. YouTube will share this content to educate people about what's really going on in the U.S. economy. And if you'd like to fix your credit to position yourself for funding, maybe to invest in distressed real estate, or maybe grow and expand or buy a business, we'd love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, or any negative item on your credit report, go to GreatCreditFast.com. Click the link in the description just below this video. Schedule a free call for tomorrow, for Tuesday. Take a look at this. So, I mean, $39 is what they're saying here. Prices in California, Chipotle, McDonald's, and other fast food chains are rising following minimum rate hike, right? And so as rates, the cost to hire basic wages, these rates continue to skyrocket, this is going to get priced and pushed onto the consumer. But what I believe is going to happen over the next 3 to 5 years is, sure, the next year, 2, 3 years is going to be very inflationary. But we're going to see a lot of these companies looking at the cost of their labor only scheduled to increase from now until 2027. It's already baked in. It's already law in places like California, where every single year their costs are going to continue to rise. And what are these founders, these franchise owners going to do? Well, they're going to look to automate the entire process to fix their cost so that they can undercut their competition and expand. It only makes sense, right? Well, here's what Jamie Dimon's warning. So stagflation fears come back with vengeance. U.S. economy could be heading towards stagflation scenario. Some Wall Street strategists are growing concerned the U.S. economy could be headed towards a 1970s style stagflation scenario amid recent signs of stubbornly high inflation and cooling economy. Now, Jamie Dimon issues this warning, but remember what Jerome Powell said. Jerome Powell said he is not cutting rates until he sees inflation going the other way. What does this signal? Inflation is going to get worse. interest rates are going to stay where they are now or possibly go up, putting more pressure on a lot of people with adjustable rate loans, home equity lines of credit, credit card debt. It's going to make things much more challenging. A string of inflation reports during the first 3 months of 2024 all came in above estimates, fueling fears that inflation could prove more difficult to conquer than previously believed. On top of that, economic growth during the first quarter unexpectedly faltered, rising to an annualized pace of just 1.6%. Now, the big question is, if rent doubled and food prices are getting out of control, are we likely going to see a scenario where people are going to prioritize feeding themselves over feeding their landlord? Could we see a lot more evictions, a lot more defaults? I believe so. I think what we're going to start to see here is landlords looking at tenants differently, not looking at them from a place of, hey, I think I could increase the rent 20% or 25% next year, but more looking at it in the way of, hey, look, this tenant's actually paying me. I want to do whatever I have to do to save this tenant from leaving and relocating, because tenants are going to start shopping around more and more and more. They're going to look for ways in which they can save money. They're going to go on apartments.com and Zillow and Craigslist and all these different platforms trying to find a better deal. And right now there's a 50-year high in apartment construction. So there are deals out there in many markets. And I think we're going to start seeing landlords taking a completely different tune the next year or two. This was a worst of both worlds. Slower than expected growth, higher than expected inflation, said David, a chief investment officer of CIBC Private Wealth. Now, this is what they are reporting, that this is inflation of the last decade, which to me is pretty comical, because they're saying inflation's right here, and it was up here now, or up here, in 2022. And they were saying this is where we were in 2018, 2019. Well, let's look at this. So if that is in fact true, and inflation only went up 1 percentage point above, let's say it goes 3% a year, 2.5%, 3% a year. Well, if that were the case, 3% will round up over the last, call it 5 years. It's 15%, 16%, maybe 18%, depending on, we're still in the beginning of the year, so depending on when this data was calculated in 2018, so looking at 15% ballpark. And you add, an extra percentage point, let's just call it 18% or 20%. Even if that is in fact true, rents doubled. You look at the price of a Big Mac, for example, because that was getting a lot of attention. In 2018, and this came out, May 2018, right here, the average price of a Big Mac was $2.29 worldwide, and the most expensive was $6.89. And so these are all different countries and locations. And now the price of a Big Mac, there's $18 Big Macs basically scattered all throughout the country now. In many, McDonald's, you could probably get a Big Mac for $13 or $14, the combo meal, right? So that, to me, is at least a 100% increase on the price of a Big Mac. And same thing is applicable with Five Guys, same thing with Wendy's and a lot of these other locations. The price of a used car in 2018 was about $36,000, right? This is according to Kelley Blue Book. Well, now the price of a used car, according to CNBC, is $47,000. So it's increased about 25, almost 30% over that period, right? So everything, fast food or just regular grocery prices have increased 25% since 2020. So not factoring in 2018 and 2019, it's 25% just across the board. So you're starting to see all these prices kind of skyrocketing, and you have to ask yourself, is this where we're really at? Because if they're saying that we're walking into this inflationary problem, I can only imagine what the next couple of years will look like. The phenomenon ravaged the U.S. economy in the 1970s and early 1980s as spiking oil prices, rising unemployment, and easy monetary policy pushed the consumer price index as high as 14.8% in 1980s, forcing Federal Reserve policymakers to raise interest rates to nearly 20% that year. So many people that married the house and date the rate, if Jamie Dimon is right here, this could be a big problem. Stagflation fears surged in 2022 as the Fed began aggressively hiking interest rates to quell raging inflation, but those mostly dissipated last year amid signs that price pressures were subsiding without a substantial hit as to economic growth. Now, this is what Jamie Dimon is saying. JPMorgan Chase Jamie Dimon is among the experts who have sounded the alarm recently over a possible return to the stagflation scenario seen in the 1970s. I think there's a chance it can happen again. The chief executive of America's largest bank said last week in a discussion at the Economic Club in New York, "I worry it looks more like the 1970s than we've seen before." So imagine this, with this big push towards automation, with record high food prices, record high everything, and you have these corporations sitting on mountains and mountains and mountains of cash. What are they going to do? They're going to invest in their companies to make them a little bit more stable, to reduce their cost, increase their profit margins, grow and expand. That's what they're going to do. It only makes, it only makes sense. Fed Chair Jerome Powell recently laminated a lack of further progress this year on inflation as he cast doubt on the outlook for interest rate cuts this year. While officials have kept the option of rate reductions on the table, they have said there's no urgency in giving a surprise strength to the economy and risk reigniting inflation. Well, I would argue inflation is getting much worse. They literally came out last week saying inflation is getting worse. Investors were previously betting on a series of aggressive rate cuts this year, and they have dialed back those expectations following a hotter than expected inflation report and cautious messaging from Fed officials. Now, you think about what this means for commercial real estate. Commercial real estate, 80% of all of these loans are issued by regional banks, 80%. And when interest rates go from 3% to 7.5% or 8%, insurance is getting out of control in a lot of these hot markets, taxes, and you have record high vacancies, so they have less income, but their expenses are multiplying. And these banks are sitting on a lot of these losses. There's discounts, 70, 80% discounts, some even 90% discounts from what they were trading for 10 to 15 years ago. And these banks are on the hook for 10, 20, 30, 50, $100 million on a single deal. And you have 20% of all of this debt scheduled to be rolled over the next 24 months. It's a big problem. So, it's 1 in 10 commercial properties throughout America. And commercial properties are, just to be clear, 5 units and above. It could be a mall, it could be an industrial complex, it could be office buildings. That's commercial property. And so you have all of these banks, they have to roll over 1 in 10 properties over the next several years, and they're holding 80% of that risk, and they're warning right now that inflation is going to get worse and Jerome Powell's not going to cut rates. It's a big problem being pushed forward onto regionals, and in turn onto America, because regionals are the ones that generally extend lines of credit to small business owners and everyday Americans. It's not the JP Morgan Chases of the world, right? Hiking interest rates tends to create higher rates on consumers and business loans, which then slows the economy by forcing employers to cut back on spending. Higher rates have helped push the average rate on 30-year mortgages above 7% for the first time in years. Borrowing costs for everything from home equity lines, auto loans, and credit cards have also spiked. And this is why I think it's so important, if you have cash, you're going to be able to really take advantage of some of these deals, because these deals, these office buildings, commercial real estate, they're going to get repriced in a very, very, very big way. They don't make sense. Who's buying a 4% return or a 5% return when you could get returns on just buying a T-bill or a CD at 5% and not deal with the headache and stress and have the liquidity, right? These cap rates are going to be going up, and with that, I believe the opportunity. So if you're a real estate investor, I think big opportunity is going to be coming. Stack cash. Put yourself in a position where you have liquidity available. In 2008, 2009, 2010, remember Invitation Homes? It's founded by Blackstone. They brought this arm out of their company, this investment arm, and they purchased 80,000 single-family homes with one philosophy. They were the dollar more guys. What they would do is they would buy these properties and they would pay up to $1 more than the highest bidder, so long as it fit this discount or replacement value structure. Meaning they would value the price of the land. They would ask, how much is it to build this property again? Let me give you an example. 2,000 square foot house. Let's say it's $200 a foot to build. That's $400,000 in just construction costs. Let's say the land's $100,000. That's $500,000 to build that structure new. They would look to buy a significant discount. They would say, we'll offer 50% discount to replacement. So they'll offer to pay $250,000 plus $1 more. So $250,000 and $1 is what they would offer. And they would go out there looking to buy all these different deals all throughout the country, and they would go to all these different auctions, and they would buy them with their squad of investors that would go to these auctions, right? They would buy books of business from banks. They would look for ways in which they could accumulate tons of inventory. I think that's the same thing that's going to be unfolding over the next couple of years. What do you think about this entire situation? Do you think we're walking into a massive wealth building opportunity, and we're going to see an insane amount of cash liquidity and net worth being moved around upwards and downwards over the next couple of years? Let's have a conversation about this in the comments below. And if you'd like to fix your credit to position yourself for funding, we'd love to help you if you have any credit issues on your credit report. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, or any issue at all in your credit report, go to GreatCreditFast.com, click the link in the description just below this video, schedule a free call for tomorrow, for Tuesday, and I'll catch you next video.